And I do want to introduce our presenters, but I'll just briefly introduce myself. So I'll sort of moderate today, keeping an eye on the Q&A. So feel free to ask questions through Q&A or the chat box. But yeah, my name is Ben Walker. I started Inspire when I was 23 and coming up to probably closer to 18 years accounting experience, but at least 17. And the author of those two books, they're Wealth for Life and It's All Sorted. And again, Wealth for Life has a heap of content there on the estate planning side of things. If you're interested, just pop me a message in the chat if you want us to get you a copy of that book as well. Also want to introduce Sakshi. How you going, Sakshi?
Good. It's a very sunny day today.
Yeah, that's it.
Yeah. Thanks, Ben. Like Ben said, my name is Sakshi, and I joined Inspire back in 2018 as an accountant, and here I am almost 6 years later as a partner. I love accounting. My parents are in accounting as well, different side of accounting, and I love what we do and very passionate about creating a legacy of generational wealth for our clients.
Awesome. Thank you, Sakshi. Very good. And we also have joining us today is Reggie from our team.
So, hi, everyone. My name is Reggie, as Ben mentioned. I joined Inspire about 8 years ago, back in 2016. I'm from Venezuela, so maybe you can hear it a little bit from my accent. But yeah, so I've been Inspired for about 8 years. I do love getting in touch with what is about to estate planning and safeguarding family wealth, of course. But also kind of like an interesting fact or interesting detail about me is that I'm also a salsa teacher. So I do love dancing, something that makes me really happy. It makes me connect with my background. You can see some photos in there of me dancing and my beautiful girlfriend in a helicopter trip that we're going to. So yeah, that's a little bit about me. Happy to be speaking to you today.
Fantastic. Well, thanks for joining, Reggie, and sharing. I'm fairly certain Sakshi is first, who's going to be walking us through the asset protection side of things, and then we will switch over to the estate planning. But I guess our first topic there is covering your assets, and I'll bring Sakshi back on the stage, so to speak, the virtual stage, and hand over to you. And I'm going to slide my camera off screen. There we go. Wow. Over to you, Sakshi.
Thanks, Ben. I love the spotlight now on there.
Well, way more personable this way.
Yes, definitely. Well, thanks once again, Ben and Reggie, for joining us today, and all our amazing clients and potential new clients that have also joined us in our webinar today. The first topic I want to cover is covering your assets. Now, as you know, estate planning and covering your assets is one of the key topics that our clients usually, in the past few years, what we have noticed is our clients have reached out to us about it. Now, the first thing we want to talk about is like the types of structures we have, like the basics of it. As you can see in Australia, I'm not going to go in the nitty-gritty details about it, but just a general overview is that in Australia, we have 3 kinds of structures that we generally see our clients trading from. As a sole trader, which is basically an individual, through a PTY Ltd, which we call a company, and the third one is through a trust. Now, trusts can be different ways: a discretionary trust, fixed trust, unit trust, different names, but a trust structure. Now, the key thing that we want to look at is the second topic, second line there is the asset protection. Now, why we want to make sure is the first thing we do is to ensure that our clients are trading through the right structure. Now, it's all great, like, to create family wealth. We want to focus on, like, protecting your assets, creating family wealth. That's what we are very passionate about. But to do that, we also need to ensure that you are trading through the right structure. You can see that individual, if you're trading through as a sole trader, you don't really have much asset protection. That's why it's across. We don't generally recommend trading through as a sole trader. However, on the other side, company and trusts are the great two recommended structures that we advise our clients to trade through, and they have great asset protection if set up correctly. Now, it is really important to ensure that, you know, the structures you are trading from are set up correctly. And in the next few slides, I am going to cover what I mean by that. Now, generally, Ben, if you can switch to next.
Can I just ask about those tax rates?
Sorry?
Those tax rates. I'm just looking at those tax rates. 47 is a flat rate.
It's the highest tax rate you can pay as an individual. So if you recall on ATO website, the individuals have different tax slabs, and yes, 47 is the highest tax slab.
And for a trust, 0? How can you say that?
Well, the trust doesn't pay tax. It's the beneficiaries of the trust that pays tax there. So the trust itself doesn't pay tax. So what our trust rule says is at the end of the financial year, any profit that the trust generates needs to be distributed to a beneficiary, and the end beneficiary of that profit is the one who's going to be paying tax. So if that money is distributed to an individual, depending upon their other income and which individual slab they will fall under, they will pay tax according to that. If that money is distributed to a PTY LTD, depending upon what other income that PTY LTD has as well, it can pay either 25% or 30%. So it's not the trust that pays tax, it's the beneficiaries that pay tax. Now, I hope that answers your question. And happy to, if you want to talk about it and discuss it further, feel free to book that strategy call and we can definitely discuss that further with you. Now, when we look at the structures, we want to make sure there's 4 categories of risk to a business. So the first one is the clients. So your business needs to has a risk, and we want to make sure it's protected from clients. The second one is suppliers. Third one is employees. And the fourth one is your competitors. So when we set up the structures, not only we want to make sure that your structure is protected, you're minimizing tax, but also ensuring that the categories of risk to a business is also reduced. Now, if we look at the risk continuum of the business structure, as a sole trader, as you can see on the further left, is a high risk because there's no asset protection if you are trading as a sole trader. However, if you are trading through a PTY LTD or a trust, you are moving towards the low risk category. Now, like I said in my first slide, we need to make sure the structure is set up correctly for us to be on that low risk side. Now, even trading as a PTY LTD or a trust, even though you are on a low risk side, there are four categories where you are still not protected. And what I mean by that is if you're a director of a company or a director of a trust with a corporate trustee, if you have committed a fraud, obviously your personal assets are not going to be protected. If you have committed a fraud, and they are going to come after you. The second one is if you have given director's guarantee. Now, what I mean by director's guarantee, often you will see if you have signed up for a commercial lease, or if you have got a company car on a lease, they will ask you to sign for director's guarantee. What that means is if the PTY LTD or the trust can't pay for the lease, it's directors personally responsible for it. So anywhere where you have given director's guarantee, you are personally liable for it. The third one is insolvent trading. If you're just trading insolvently, you are personally liable for that as well. And the fourth one is superannuation and pay-as-you-go withholding. As a director, you are responsible for paying your employees super and PAYG withholding, and you will be personally liable for that as well. Now, when we look at asset protection, the key points we need to look at is the asset person and the risk taker in your family group. When we set up structures or when we review structures for our clients, we want to make sure in a family group, there's a risk taker role and there's an asset taker role. Now, what we mean by that is if you are a director of a company, Pty Ltd, or director of a corporate trustee, if you're trading through a trust, we want to make sure you are, one person is the director of all the trading entities, director of the corporate trustee companies, and ideally hold no assets. Now, the other side of this is the asset taker role, where the asset person is basically the one who is controlling the assets and holding the entity's assets, such as, like, say, for example, if you have a bucket company where all the profits have been distributed from the trading entity to the bucket company, the asset person is the director of that company. If you have a family trust that has an investment property, we want to ensure that your partner is the trustee of that trust to ensure that they are controlling the assets. Now, ideally, we do recommend the ownership of family assets as well in their name. So say, for example, main residence, cars that you have personally in your personal name are held in their name as well. And their typical role is, as you can see, is they're usually the shareholders or the trustees of the trust and also the appointers of the trust. So if you're not a current client and as we're going through the slides and you believe that, you're not sure who the risk taker in your family group is and who the asset person is, I would highly recommend booking a chat with us so we can identify those things. And if there's any structure updates required, then we can definitely guide you through and help you through to making sure that there's asset person and the risk taker. Now, when we do those chats, what we will determine is the asset protection review, basically what we have discussed so far, making sure that there's a risk taker versus asset person. There's a clear definition between the two roles, what your existing structures are, and ensuring that there's tax efficiency there, and ensuring that your profits, say, for example, your profits in the trading entity are protected as well. And we will talk about then the strategies to improve your asset protection. If you're potentially thinking of buying another investment property or a family home, let's talk about the ownership of it. Who owns the business shares? We will look at that. Gift and loan back strategies, we will discuss that. And then the asset trusts and securing your debt owned from the trading entities, which is what we call Division 7A loans or director's loan, things like that. So it is a very broad topic, asset protection, but what we wanted, the key things we want to look into is talk about the risk taker and the asset person, and then from there go back to, okay, then covering the asset protection and look at these key areas, which is the structures and the personal assets, how they are held. That's pretty much it from my end, Ben, unless you have any comments to add on there.
Oh, no, that was great. And yeah, I guess thank you very much, Sakshi, for running through the asset protection side. And yeah, as Sakshi said, if you want to have a further chat, feel free to book that initial chat in, or if you're working with us and you just want to ask some other asset protection questions about your structure, if you're a current client, then just book a call in with the accountant that you work with, and we can go from there.
Amazing. What I'm going to do is I'm going to now hand over to Reggie, who's going to talk about the leave your legacy.
Awesome. Thanks, Sakshi. Cheers. Reggie.
Awesome.
Yeah.
Awesome. Thank you, Sakshi. Yeah. So as you can see, or as you can imagine, the asset protection topic that Saksha was mentioning, kind of like clicks or links together with the estate planning side of things as well, which in general is what what we call, or what will lead into leaving your legacy, right? How do you make sure that your assets are protected, but also the personal side of things are also covered when you are not here, right? So and if you can move to the next slide, yeah. So interesting fact is about 60% of Australians will die without a will. Which means basically that there is no plan after death, or what happens with your assets when you are not here. So if you don't have a will, or it's outdated, your loved ones will be the ones that will have to deal with that when you're not here. Usually they'll have to be dealt with the government on how to split the net state, and it might be subject to family provision proceedings as well in court, and which might lead to by to the law distributing your estate in a way that may have not the way that you will have decided to if you were made a will. So yeah, so the way I like to think about it is when I'm not here, how do I make sure that my loved ones, the people that are still here, how do I make their life easier when I'm not here, right? And how do I leave clear instructions for them about what I would like, or what my wishes were, right? So that's as I was mentioning before, that connects with the asset protection side of it, because estate planning is not just a will. Okay, so that's what I'm getting to, because if you have some sort of like more complex structures, like like a trust or a self-managed super fund or a company, there are different type of things that we need to look after as well, or things that we need to pay attention to as well, right? So just to set some reference in about what we need to talk about is your will only deals with your personal side of things, right? So think of your bank account or investments owned on your personal name, or your home, for example. So the will only cover what's held within your personal name, right? So yeah, and other and sometimes you might think, oh well, I don't hold too many assets. I'm not sure. I don't think I will leave too much for the loved ones. But there are things that people very often forget that they will have as well, right? So one is super, for example. It's that's on your name, and that's important to account for. Or life insurances as well, whether if it's within your super or outside of super, that can be a big amount of money in there. So the question is like, where does it go, right? So we want to make sure that that's covered in there. When the assets are held jointly, usually like there is no particular document that you need to refer to. Normally the survivor will be the one that will take the ownership for the asset. So think of like a property or your home. If mom and dad are the ones holding or owning on both of their names, if dad passes away, so then mom will be the one who will take the ownership of the property, right? Now, when we refer to companies, we want to refer or see who the shareholders are, right? So if you have a bank account in a company, for example, and that the bank account, if you have a bank account in the company, that means that the bank account is not in your personal name; it's on the company's name, right? So the will wouldn't cover that. So when we look at it, what we need to understand is who the shareholders are, because they are the ones that ultimately control the company. and who the directors are, right? Because the fact that you are a shareholder, not necessarily you need to be the director. So the director will be the one, that signs the documents, has access to the bank account, etc. And but the shareholders will be the ones that technically will be the ones that hire the directors, right? So when we talk about companies in particular, so and that kind of like ties up a little bit with what Sakshi was talking before about asset protection, is the directors in a companies are the ones that that might be subject to risk, right? So then that's when we refer to that risk taker or the asset person. So if you're a client of Inspire, you will normally see that there will be one person that we try to get as a risk taker, and there's the person that's away from the director risk that we will call the asset person, and that will hold the majority of the assets in the family group, protected from the business risk, right? So yeah, so that's kind of for the companies. In regards to the trust, again, if you're also a client of Inspired, you will see that it happens very often, or typically you will see that the shareholder of a company can be a trust as well. So then the next question in there is, well, if the trust is the shareholder of the company, who is the one who controls the trust, right? So if it's the same person that if it's the same person that passed, for example, so then the question will be, okay, so then who controls the trust after this person has passed, right? So there is when we get into kind of like what we call that, like succession planning, and when we see estate planning and asset protections tied together, and we see things from kind of like a holistic point of view, right? So if there is a line of successors, appointers in the trust, so for your reference, so an appointer is the person that controls the trust. Therefore, that will be the person that controls the company if the trust is a shareholder, right? So so when you think about it, you might realize that if you set it up properly, you can have a proper plan of succession to the right people that will take place if you pass. It's all kind of like linked together, right? Another bit is superannuation, and so the superannuation has for the superannuation, they will need to be prepared a document that is called binding death benefit nomination, which is basically a document that says, well, here's where my super balance is going to go to when I'm not here, okay, when I pass. Okay, so and this can be part of your net state. Basically can go to your net state, or it could be a particular person if you decide to. Yeah, even if you have a self-managed super fund, for example, you can that is the same mom and dad have a self-managed super fund together, you can transfer your balance to if dad passes away, the balance can be transferred to mom within the same super fund, and then things continue kind of like that way, right? So so yeah, and then the last bit will be the insurance payout, which basically means we need to see who is the policy owner of the who the policy owner is, and then where that insurance is sitting. If it's sitting, for example, inside of super, so then it will be covered by that binding death nomination document that I just mentioned. So yeah, it will be covered in there. Yeah. Yeah. So now an important thing to note as well is that when you set estate planning, it's not that you just forget about it. Okay, so there are certain events that are key, that when they happen are key for you to or as it will be a highlight for you to say, hey, I might need to have a look at my wills and see if, or at my estate plan in general, and see if I need to review it, or see if it's still relevant based on the current circumstances, right? So one of them is marriage, for example. You know, if you were single, then you get married, so then your circumstances are different. So it might be a good opportunity for you to review your estate plan and see if things need to be changed in there. The second one is breakups, obviously, not a nice thing, and so it's a good moment as well to make sure that your wills and estate plans are updated and based on that current situation. Newborns, if you didn't include your kids or future kids in your previous estate plan, that will be another time for you to review your wills, of course. Time, obviously, you know, even if your family circumstances have changed too much, and your wealth can grow over time, or your circumstances in regards to what your situation at the moment cannot be wouldn't be the same as about 2 to 3 years ago. So yeah, it's good to review your wills maybe every 2 or 3 years and see if it's still relevant in there. If you're traveling for an extended period of time, and particularly if that includes high risk activities as well, it's a good thing to consider as well, to review your wills. Unfortunately, if you're having health issues as well, and you know, going through, if you have diagnosed with something, with some sort of like terminal illness or something like that, it's good to have those plans or those rules or that set already, just in case, you know, and also just to make sure that, you know, if there's a moment in which you cannot make decisions or things like that, the people that are around you, they already have, you know, some sort of like instructions or guidance on what your wishes were. Okay. Oh, sorry. Something important that I need to mention in there is that within the estate planning, there is also there will be the preparation of the enduring power of attorney as well, which is basically a document that allows people, the person that you choose, to make decisions on your behalf when you can't. Okay, so and particularly in those moments when you know, if you're either, you know, traveling and you need someone to do some stuff for you here in Australia, so then that document can help that person, you know, to act on your behalf. But particularly if you are having some health issues and, you know, you cannot make decisions, either decisions about your own health or decisions about your finance, sorry. Yeah, that will be a good, or that was a document that allows those people to make those decisions on your behalf. All right. And last but not least, is the testamentary trust. Okay, so sorry. Yes, cool, awesome. Yeah, so testamentary trust. So testamentary trust is a type of trust that activate when the wills are executed. Okay, so when you pass, the wills activate the testamentary trust for each of the beneficiaries. Okay, so if you didn't have a will, if you didn't have a testamentary trust set for the beneficiaries of your wills, so what will happen is that any part of the estate or gifts that you any part of the estate that you give to someone, an individual, it will go directly to their own personal name, right? So now the detail in there is that when that person's received that part of the estate, you don't know what their personal circumstances are, you know. So they might be going through a divorce, or they might be getting married, or they might be, you know, so that will kind of like get they would receive those assets, and those assets might be in risk of whatever personal situation they will be going through at that time, right? But with the testamentary trust, it kind of builds a little bit of a kind of like a wall, or it's an instrument for you to protect those assets from their personal side of things. And because the assets that they receive will be held in a trust, okay, rather than on their personal name. So they can manage that away from whatever personal circumstances they will be going through at that time, right? So if you're leaving something, for example, if you have kids that they are under 18, the testamentary trust is an excellent instrument to protect those assets, to keep those assets in a safe place for them, right? And also another important bit is that if you distribute to minors, basically they will be taxed as an adult, but they wouldn't get the tax-free threshold. Okay, so that is if you distribute or you leave anything to them individually, right? But something interesting about testamentary trusts is that when the testamentary trusts are the beneficiary is a minor, and that testamentary trust, let's say that you have that you live in shares, for example, then that shares generates dividends or some sort of income. When you distribute that income to the kid, that will be an that will be called an accepted trust income, which the testamentary trust which is applicable to a testamentary trust. So that means that they will be taxed at a normal adult tax rate. That means that they will have access to the tax-free threshold. Okay. Yeah. So and in general, the testamentary trust also protects the assets from future partners' relationship breaks down, or for kids spending it, of course, and also helps to keep it within the family. And another wall, or another add up into the protection of those assets through the testamentary trust is that you can also exclude people from being a beneficiary. Okay, so the execute you have a person that can be the one that controls the trust, but not necessarily benefit from it. Okay, so yeah, so this depends on each other's circumstances, but yeah, you want to keep in mind that within the trust, you also have the option to exclude people that you don't want to get any benefits from that particular trust as well. Okay. Cool. So yeah, so I will thank you so much.
Sorry,
and then I will yes. Yeah.
Sorry. Well, one thing I thought about while Reggie was discussing and sharing, we did cover, I think, a few slides before about the directors and, like, if the director passes away, what happens to the control of the trading entity? It's such a unfortunate circumstances. So when we do estate planning process, what we also look at, successor directors and trustees, to ensure that you have backup options there as well. It might not be your asset person who's doing it. I'll relate back to my personal family circumstances just to give a bit of a context. So say, for example, my parents have a business and they have a trading entity, right? And dad's the controller of it. If something happens to dad, even though everything goes to my mom, the successor director is myself. And the only reason we have done that is because mom's not really involved in the day-to-day business, or doesn't have much context on it. So when it is really important, if you already have estate planning done and you have wills done, just making sure that you have successor directors and trustees of it as well, so that we can, the operations of the business, especially if you have employees, things like that, the business side can run smoothly.
Mm-hmm.
Sorry, Reggie, back to you.
Yeah, no, awesome. Yeah, no, yeah. So yeah, as Sakshi was mentioning, yeah. So that bit is really important. But I guess like the next bit is for Ben to try to kind of go through. But yeah, thank you so much, and just handing it over to you, Ben.
Cool. Thank you. And I'll need to get me slide stuff sorted. Oh, sorry. One more time. There we go. That's better. Cool. All righty. Thank you, Reggie. So what about the process that we go through to help our clients with estate planning? Well, it's actually involving three different people, yourselves as the clients, us as the accountants, and also we get lawyers involved as well because they need to actually do the legal drafting of the wills. We call this process advisor facilitated estate planning, where all three people are in the room and working together. And again, we chose that because the complexity we get with business owners around, trusts and companies and self-managed super funds, it's just not so simple. And we want to make sure that estate planning is done collaboratively so that you don't miss anything, or, the very common thing is to just do a will for your estate planning process. But again, we learned throughout this webinar that the estate plan is way more than just a will. What is the actual steps involved? The first thing is us and our clients go through a planning stage. We sort of get the intentions of what the client wants to happen with their estate, with the assets that are spread throughout the different entities. We summarize these instructions, send it over to the lawyers together with very detailed info around the structures, who owns what, who's directors, who's appointers, trustees, all that sort of stuff. We have a three-way meeting, lawyers, clients, and us, and then documents are prepared from there, and we do a signing meeting to get those all executed. So that is our process. And again, just some things to remember. Often hear one reason to not do this stuff is that, I don't really have a lot of money, so let's not worry about it. But again, I think Reggie said it earlier that if you've got an insurance policy for a couple of $1 million, and if you were to die, that'll actually pay out potentially to your super fund or potentially to you, depending on the policy owner. And then you've got a $1 or $2 million asset to deal with. If you've got no instructions for that, you hand over those instructions to the government, or a pretty hectic legal process. And the other thing is, investments and property prices have gone up over the last few years. While it might not have been so relevant, you felt a few years ago, what about now? So yeah, that's some things to remember. Now, if you do have questions about the asset protection or the estate planning side of the webinar, feel free to pop them in the Q&A box now. But I'll just wrap up and then we'll switch gears to Q&A. In terms of next steps, if you do want to chat more with us, and let me go over here. So the next steps, if you're a client of Inspire, you want to have a chat about either asset protection or estate planning, feel free to reach out to the accountant that you work with at Inspire, and they can sort of walk you through the next steps there, or any other questions that you have. If you're not working with us and you want to talk more about this stuff, then feel free to book in for an initial chat. The link is in the chat box, or inspire.accountants/chat, and you'll get there. All righty, over to the Q&A. Now, I did see one come through from Saj. What is the best way for a dual citizen to manage estate planning with assets in Australia and the UK? Does this process need to be done in both countries? The short answer is yes. So we do have clients with assets, not just in Australia, and basically, ideally, both countries, lawyers and accountants, are aware of what the plan is in the other country, and you can just involve them that way. But our understanding from taking clients through this with international assets is that both sets of docs need doing. Yes, so basically one in Australia and one wherever your assets are overseas, and that they're totally different legal processes. Jaro, I don't know what you're about to say. Is it safe?
Don't worry. Yeah, it's safe. It's safe. I just wanted to add something to what Reggie was saying about the events when the estate planning has to be reviewed.
Yes.
and he mentioned about, I think it was 7 or 8 events.
Yes.
And I
this
just
one here.
wanted to, yeah, that's right. And I just wanted to mention 2 things. I mentioned in the chat, one was the de facto relationships, because
Yes.
whereas marriage is planned and it's kind of obvious event, de facto relationships might be established retrospectively by the family court based on a certain attributes.
Yes.
One of the obvious one is the cohabitation for 1 year, but it's not the only, only one. And the second one that relates to that as well and relates to the marriage is to consider prenuptial agreement. And I believe that's a very important part of estate planning as well. So I just wanted to, I just wanted to add those 2 things.
Yeah, cool. And even that sort of stuff involving us, not estate planning lawyers, but family lawyers in the process, if that is something that you'd need to check in or get advice on, for sure.
Yeah.
Thank you. All righty. All right, there's currently no other questions, so we might leave it open for another 60 seconds before we sign off. But yeah, just want to thank everyone for joining today, and yeah, I hope it's been helpful. I hope it has also encouraged you, if you don't have this stuff sorted, to get it sorted. And to do something about it. The worst thing is hearing all this stuff, thinking it's a great idea, and doing nothing. So again, if you need help, reach out to our team. And if you did miss any portion of this webinar, then there will be a recording sent out to everyone who registered. Cool. All righty. Too easy. Well, thanks again for joining today, and I hope you have a fantastic rest of the week. Cheers.